and welcome to Finextra. I'm Thea George and I'm here with Jonathan Charley of SAP. We're at Cybos 2016 in Geneva and we're talking about the rise of robo-advice. Jonathan, thank you for joining me.
No problem at all.
So why do you think we have seen such a rise in robo-advice in recent years, and what role do you think fintechs are playing in driving the growth?
I think there's a number of factors that are coming into play. One is around economy, one's around regulation, and then there's the technology side as well. In terms of the economy, what we have seen obviously is a significant slowdown. We've seen negative interest rates and returns really going very poorly. We've also seen that active fund managers have found it increasingly difficult to get decent returns, and particularly in terms of the amount that they're growing in the market. And secondly, we've got the regulation as well, which is things like RDR, which has actually removed advice from the bottom end of the market, because where customers thought that they weren't paying a lot, and in fact it was in commission, they're now having to pay a large fee up front, and so they're looking for alternatives. And in terms of fintech, it's really the fintechs that have actually been leading on the way on robo-advisors, so the likes of Betterment have come into the market. And the reason they've been able to do that is because supercomputing has become a much lower cost, and therefore customers are able to have access to that.
And how do you think the rise of robo is impacting traditional advisors, and how well do you think they're responding?
Well, I think there's a combination. They're certainly filling in a vacuum where traditional firms are no longer able to play because of the things like RDR again. But they're making it much more acceptable to start looking at investments, so they're helping to break in. And traditional players have adopted several models. Some, they've gone with a fintech, tested it out, and then decided that they want to go and build their own, or they're building their own, or worse still, they're ignoring it and saying, well, that's the bottom end of the market. But what actually we're going to see is the next wave of robo-advisors, which will be going from passive funds into much more active funds and other instruments. So they'll actually be moving right into the core of the other wealth providers.
So when it comes to responding, what do you think the traditional providers need to do from a technology standpoint to really respond?
Well, I think first of all, they need to be looking at a number of models. It's a hybrid model where they're actually using robo-advisors to support the actual advisors, so that way they can really focus on where the human interaction is needed. Secondly, they can actually have robo-advisors for the bottom end of their market where they don't provide that level of support, but they need to be looking at how they are going to play in that market if they are going to survive in the long term.
Jonathan, thank you.
Okay.
And thank you for watching.